Welcome to this video on payday loans. If you're here, you might be wondering what a payday loan is, how it works, and whether you qualify for one. In this video, we'll answer all those questions and more. Let's get started. Section 1. What is a payday loan? A payday loan is a type of short-term loan that is designed to be repaid on your next payday. It's typically a small amount of money, ranging from a few hundred to a few $1,000s, that you can borrow to help cover unexpected expenses or bills that you may not be able to afford at the moment. To get a payday loan, you typically need to provide proof of income, a valid ID, and a checking account. You'll also need to write a post-dated check for the loan amount plus fees. The lender will hold onto the check until your next payday, at which point they'll cash it to pay off the loan. However, payday loans can come with very high interest rates and fees, which can make them difficult to pay off and can trap borrowers in a cycle of debt. It's important to understand the risks before taking out a payday loan and to consider alternative options if possible. Section 2. How do payday loans work? Payday loans are short-term loans designed to help individuals who need quick cash to cover unexpected expenses or bills between paychecks. The process typically involves the borrower providing the lender with proof of income, a valid ID, and a checking account. The borrower then writes a post-dated check for the loan amount plus fees, which the lender holds onto until the borrower's next payday. When the borrower's next payday arrives, the lender cashes the post-dated check to repay the loan. If the borrower cannot pay the loan off in full, they may have the option to roll the loan over for an additional fee, which extends the loan term but also increases the amount owed. Payday loans can be obtained both online and in person at payday lending stores, and the loan amounts and fees vary depending on the lender. The interest rates on payday loans can be very high, sometimes reaching over 400%, making them a very expensive form of borrowing. It's important to be aware of the risks associated with payday loans, as they can trap borrowers in a cycle of debt. Due to their high interest rates and fees, borrowers may struggle to repay the loan on time, leading to additional fees and charges. Some payday lenders have been accused of engaging in predatory practices, such as targeting vulnerable borrowers and encouraging them to take out loans they cannot afford to repay. Before taking out a payday loan, it's important to consider all other options, such as borrowing from friends or family, negotiating with creditors, or seeking assistance from nonprofit credit counseling services. If a payday loan is the only option, be sure to read and understand the terms and fees, and only borrow what you can afford to repay. Section 3. What are the risks of payday loans? While payday loans can be helpful in certain situations, they also come with some risks. The interest rates on payday loans can be incredibly high, sometimes reaching over 400%. This means that if you don't pay off the loan on time, the fees can quickly add up and become unmanageable. Additionally, some payday lenders have been accused of predatory practices, such as targeting low-income borrowers and trapping them in a cycle of debt. It's important to be aware of these risks before taking out a payday loan. There are several risks associated with payday loans, including 1. High interest rates. Payday loans typically come with high interest rates, which can be as high as 400% APR. This means that if you borrow $500, you could end up owing $600 or more in just 2 weeks. 2. Short repayment periods. Payday loans are designed to be repaid on your next payday, which is typically 2 weeks away. This short repayment period can be challenging for some borrowers, especially if they have other bills to pay. 3. Trapping borrowers in a cycle of debt. Some payday lenders have been accused of using predatory practices, such as offering loans to people who can't afford to repay them. This can lead to a cycle of debt, where borrowers are continually taking out new loans to pay off old ones. 4. Additional fees and charges. Payday lenders may charge additional fees and charges, such as late fees, processing fees, and prepayment penalties. These fees can quickly add up and make the loan even more expensive. 5. Risk of identity theft. When you apply for a payday loan online, you may be required to provide personal and financial information, such as your social security number and bank account information. This information can be at risk of being stolen by hackers or other criminals. It's important to carefully consider all of these risks before taking out a payday loan, and to explore other options, such as borrowing from friends or family, negotiating with creditors, or applying for a personal loan from a traditional lender. Section 4. Do I qualify for a payday loan? To qualify for a payday loan, you'll typically need to meet the following criteria. Be at least 18 years old. Have a steady source of income. Have a checking account. Provide proof of income and a valid ID. Keep in mind that payday lenders may have additional requirements, and not everyone will be approved for a payday loan. It's important to do your research and consider all your options before taking out a payday loan. In conclusion, payday loans can be a quick and easy way to get cash when you need it, but they also come with risks and potential drawbacks. Before taking out a payday loan, be sure to understand the terms and fees and consider all your options. Thank you for watching.